Welcome to The Explainer. I'm absolutely thrilled to have you with us today because honestly, we're diving into a fascinating and kind of complicated landscape, the 2026 gold market. For generations, gold has been this rock-solid bedrock of wealth, but the rules of the game have completely changed. Today, we're going to break down exactly how modern gold investment strategies work. We'll be putting physical assets head-to-head with their digital and financial counterparts, using the raw data right in front of us.
It's the ultimate generational clash, isn't it? You're scrolling through your phone, and boom, you see an ad promising you can start building a gold empire for literally one single rupee. Meanwhile, your grandmother is sitting there adamant that if you can't physically hold it in your hands, it's not real wealth. And this debate has literally never been more heated. With domestic gold prices hitting an astonishing 97,000 rupees per 10 grams in early 2025, the stakes are so high right now. Everyone has a strong opinion on how you should be buying it, but following the wrong advice could quietly drain your returns.
Okay, let's dive right into this. Here's our roadmap for today. We're going to unpack the modern gold dilemma, pit physical against digital, explore regulated routes like ETFs and SGBs, do a head-to-head comparison, and wrap it all up with your best strategy.
All right, Section 1, the modern gold dilemma, how we are evolving past those traditional routes.
Moving right along to Section 2, physical versus digital gold. Basically, the old guard taking on the new age.
When you buy the old guard, physical gold, take a look at this number, 11 to 23%. That is wild. It's the shocking, hidden entry premium investors pay above the actual market value when buying physical gold jewelry. How does that even happen? Well, the exact moment you purchase physical gold, you're immediately hit with making charges that range anywhere from 8% to 25%, plus GST. If you're buying gold strictly as an investment to grow your wealth, starting out in an 11%.
And the friction of physical gold definitely doesn't stop there. You are literally paying tax on tax. You've got a 3% GST on the base value of the gold, and then, get this, a totally separate 5% GST entirely on those making charges we just talked about. Plus, once you take it home, you got to keep it safe, right? Bank locker fees for physical gold will run you anywhere from $2,000 to $10,000 every single year. So year after year, those fees are just quietly chewing up your investment returns.
Now, in sharp contrast, we have its new age alternative, digital gold. This lets you buy and store 999 purity, that's 24-karat gold, entirely online in these tiny fractional amounts. The barrier to entry, completely shattered. You can literally start with a single rupee. What's brilliant about this model for small investors is that it totally wipes out those making charges and pesky annual locker fees. You just pay for the gold itself, a 3% GST, and a small platform spread. It's incredibly accessible.
But, we have to look at the full picture impartially here. Back in November 2025, SEBI dropped a pretty clear warning. Digital gold actually sits in a regulatory gray zone. Because it's not officially classified as a security or a commodity derivative, it lacks the standard investor protection safety nets of the formal financial sector. Your investment relies pretty heavily on the private digital platform's own stability and security.
Now, what's really interesting about this next slide is how we step into the safer avenues. Section 3, regulated routes, ETFs and SGBs, the financial instruments.
If you want exposure to gold prices without the physical hassle or the regulatory uncertainty of the apps, these are the heavy-hitting financial instruments you need to understand. Let's look at this direct comparison. Up top, digital gold, an unregulated gray zone where you lose 3% to GST right at the point of purchase. On the bottom, the gold ETF, or exchange-traded fund. Gold ETFs are clean, SEBI-regulated mutual fund products that hold paper equivalents of physical gold stored safely in insured vaults. And crucially, there is absolutely zero GST on your entry purchase.
And investors have caught on to this advantage in a massive way. Just look at the explosive retail adoption here. Between April 2023 and March 2024, retail adoption just exploded, driving gold ETF assets under management from 22,000 crore to 35,000 crore. Why the rush? Because you can start with as little as 50 to 100 rupees. The annual expense ratio is incredibly low, just 0.5% to 1%, and the tax treatment is highly favorable. We're talking a clean 12.5% long-term capital gains tax after 12 months.
Then there's our fourth contender, sovereign gold bonds, or SGBs. Issued by the Reserve Bank of India on behalf of the government, SGBs offer this fascinating dual advantage. Not only does your investment track the rising price of gold, but you actually earn a 2.5% annual interest rate. credited semi-annually directly into your bank account, so you get capital appreciation plus a regular income stream from the government.
Actually, scratch that. There is a very specific catch for the year 2026. While SGBs are famous because their capital gains become completely tax-free if you hold them to their full 8-year maturity, fresh issuances by the government are currently paused. You can still buy existing bonds, but you have to hunt for them on the secondary market. This means liquidity is quite limited right now, and they often trade at a premium above the actual gold price.
Let's move to the next part and see how this all builds up. Section 4, the head-to-head comparison. Physical versus digital versus ETF versus SGB.
All right, this matrix lays the whole thing out beautifully. Notice the high friction of physical gold, high entry minimums, heavy taxation through multiple GSTs, and only moderate liquidity. Then look at digital gold, the amazing convenience of starting at just 1 rupee and high liquidity, but hampered by a roughly 20% long-term capital gains tax and entry GST. Contrast that with gold ETFs. They require just $50 to start, have 0 entry GST, highly favorable 12.5% taxation, and the absolute highest liquidity. Finally, the SGB. While it requires a higher minimum of around 7,000 rupees for 1 gram and suffers from limited liquidity right now, it remains totally unmatched for long-term holders by being completely tax-free at maturity.
So, the crucial point is, how do we use this? Section 5, your best gold strategy, matching goals to assets.
Because data is only as good as what you actually do with it, right? Let's shift to applying these instruments to your own portfolio. If we distill everything we've covered today into a quick decision matrix, here is exactly how you should allocate your funds in 2026. If you are buying for a wedding, for tradition, or for a family heirloom, stick to physical gold. Just know you're paying a premium for that experience. If you're a student or first-time earner looking to start a habit with pocket change, use digital gold. If you're a serious investor looking for low-cost, highly liquid, SEBI-regulated portfolio diversification, the gold ETF is your winner hands down. And if you have a lump sum that you absolutely do not need to touch for 8 years and want the ultimate tax efficiency, hunt for an SGB.
I want to leave you with this one thought to chew on. Are you buying gold for tradition or for wealth? Mixing those two up can be incredibly costly. The 2026 market offers some fantastic tools, but you have to pick the right one for the job. If you found this breakdown helpful, do me a favor and share this explainer with a friend or family member who might be a bit confused about how to buy gold today. Stay smart, stay invested, and I will see you in the next one.